Okay, good afternoon, everybody. I think we're going to try to kick this off so we keep to the schedule. So welcome. This is the distressed credit trading opportunities in commercial MBS. I've taken the liberty of expanding it just to say, well, let's talk about CRE in general, because as you'll probably hear, many people, including the panelists here, are looking in the private markets for where they can find outsized returns, better relative value. Before we start, I'm going to turn it over. I'm going to let each of the panelists introduce themselves. And I will note that Pasquale, who is our third panelist, shot me a note, said there was an accident on the highway. So if you see a guy come running in and running through, there's no need to call security. He belongs here. So with that said, I'm going to turn it over to John Devaney.
As way of introduction, I've owned a broker-dealer called United Capital Markets that I founded in 1999. We've always specialized in modeling and providing liquidity to banged up asset classes in structured finance. So we've really traded every area: aircraft franchise, HELOCs, manufactured housing, most of the areas that had issues with the underwriting and then subsequent liquidity or that were difficult to model. So my whole company has just done that for our 20 years. I did take off for a couple years and was kind of out of the market. Now COVID's brought me back, and now we're dedicated to making markets in CMBS. It's interesting because I'm a newcomer and in a pool of very sophisticated CMBS players, but we're focusing on the triple B, double B, and single B stack of conduit, mainly 2012 to 2015, that have had issues with the fallout of COVID, as well as SASB. We've traded about 2.5 billion of these securities now flowing through our firm in about 20 months. We only buy bonds as a principal, as a point. We don't like selling complex things to our downstream clients without owning them first with our own money. So we have a different take than some other dealers.
Great. To my left is Avner Hussein, Managing Director at Fortress.
Yeah, so I've been at Fortress for 14 years. I'm a senior partner and I co-run our structured product business. We have a series of private credit funds that we invest, episodic in the securities market, and then we do a handful of private transactions. And in addition to that, we also have kind of a more core fixed income strategy that we're kind of more actively kind of buying and selling securities. It's called our asset-backed income fund.
Great. And I'm Alan Todd. I'll be moderating. I'm head of U.S. CMBS strategy at Bank of America. So I think let's start off with the easy question, and I'll start with you, Avner. Can you describe the current landscape of what's out there? How has that changed? What was it like pre-COVID? What did COVID do? And what are you focusing on now that may have kind of, been shaken loose?
Yeah, sure. So, I think there's the simple answer is there's, not much distress out there, whether it be kind of securities or private markets. In terms of kind of how we went from where we were, I think at the onset of COVID, there was obviously a ton of uncertainty in the marketplace. Public markets were tanking, and what you ended up seeing was there was, some real forced selling in the structured product markets as you had repo and redemption concerns from mortgage REITs, et cetera. And that led to kind of the first set of opportunities, which is kind of more the kind of forced selling, where you're able to buy public securities, structured products specifically, at deeply discounted prices because people needed liquidity. And that unfortunately was like a 2-week to 1 month window. And then, kind of after that, there were still opportunities, but mostly in kind of more COVID affected sectors. So specifically, hospitality, office, to some degree. And then, I think what put a floor on everything was just central bank action intervention. I think that allowed people to really get comfortable that they weren't catching kind of the proverbial falling knife, and there was a decent amount of capital on the sidelines that was able to kind of participate. The next, call it 12 months, there was more of illiquidity in the marketplace, where we were focused a lot more on private market transactions. There weren't that many assets that traded hands. There was a handful of hotels because of the need for capital. There was a decent amount of kind of balance sheet repair and rescue financing that we kind of focused on. But again, that was 12 months, and I think the big kind of the big negative to the opportunity set was how kind of CMBS was being handled. People were getting kind of extensions and windows to kind of breathe, and I think that eliminated a lot of that distressed supply. So, and then I think you started seeing kind of the vaccines, zero rates, and just kind of euphoria spread, plus that combined with a ton of capital on the sidelines, and you're in an environment where assets are kind of again reaching peak pricing, and so I think the distress has kind of gone away in its traditional sense.
So I'm going to turn a bunch of stuff over to you now, John, because Avner said a couple of things here that I think are pretty interesting, and I think you'll have a good insight into. So no distress, right? 2-week period. But I see your runs that your firm sends out on Bloomberg, and I would argue that triple B, double B. I think we need to define what is distress. Are you trying to get something for 10 cents on the dollar and ride it back to par, or are you looking to buy something that you buy at 40 or 50 and you ride it to 60 or 70? So I guess my first question is, how would you define distress in what you're doing? And the types of returns that you can get, or you think you can get, where you focus most?
Sure. All distressed markets are relative to where the normal risk-based pricing might have been. That's really what arbitrage is. There's a certain risk level for the triple B and the double B, et cetera. So to say that I'm a distressed trader and just going after the $10 or 20 or 50, it's all relative to which class you might be in. Just to back up and kind of highlight again the landscape that we're in and say it, I agree with all of your comments that you made, Avner, but the reason why, and here it is, here's where we are now, and we definitely had the forced selling before, and there was a lot of shit going on, and we were all very nervous about the pandemic and what was happening to the world and to credit and the stock market and everything. We've kind of gotten past that. Right now, the triple B and the double B and the single B in conduit, for example, are trading all at extremely distressed levels for the 2012, 13, 14, and say 15 and some of the 16 vintages. And you ask, why is that? Well, I prepared with Isaac, who's rejoined me, who joined me out of Berkeley Financial Engineering School, and we're data scientists. So if it's an understatement to tell you guys that I've been studying malls. I've studied every damn mall there is. I've got them all by sponsor. I got pivot tables. I got every mall there is.
You've got a credit card bill to show it?
Oh yeah, we bought all these systems and everything to study malls. Now, the reason why these areas are still trading distressed, it's all the enclosed mall industry. It's just coming down to that. Most of the hotels, more or less, have all recovered. We built a tool that looked at every single mall in CMBS and took there's a coincidence, there's 10 billion coming due in 12, 13, 14, and 15. So there's 40 billion malls that are coming due. We put a cap rate and ignored if it's current or on the mortgage or currently delinquent. And by the way, on that universe, there's 18% of malls that are not paying the mortgage payment. We ignored that. We put a cap rate and made a big two-way table, but with every mall. And we got 8, 9, 10, 11, 12, 13, 14, 15 cap rate. And just to back up, I've also got files of every single appraisal that's been ordered by all the special servicers, because we touch more of the stuff that's going wrong that mandates ordering appraisals. So we're tracking all the appraisals. A good appraisal would be 10%. That'd be a dream. The appraisals are 12, 15, 18, 20% appraisals on some of the distressed stuff. And so we found that 73% of every single mall that's coming due in the next 4 years is underwater at a 12% cap rate. So then you'd say, well, geez, I'll tell you, I'm long the D, E, F across all conduit. I'm not hedged, and I believe in the risk-reward proposition more than anything. You'd be like, okay, well, how could that possibly be? How could you be long all this stuff and, there's potentially a huge issue with the maturity wall that's coming up in year 1, 2, 3, and 4. I mean, I disagree with Carl Icahn. I think he's wrong. I think a lot of the guys that have shorted the CMBX 6 series, triple Bs at 73, do not understand how expensive it's going to be to deal with the extensions that are going to happen for 3 to 5 years until the legal documents say they can't extend. This COVID isn't fair. The special services are already giving unbelievable flexibility to certain parts of the commercial real estate market. For sure, the government failed in their ability to help out one of the hardest hits of our economy, which is commercial real estate. And it's still possible that they could come through the Senate or the House with some programs that could give some preferred equity. They floated a lot of different ideas, but they bailed out all these different industries, and the airline industry, and they really forgot about so some of these parts of the commercial real estate market, like hotels and malls, that are the backbone of a very large percent of employment. So anyway, but that's where we are. The enclosed mall industry has a couple big risks that we're all going to watch unravel. One, maturity risk. I believe that the COVID actually bailed out a big risk that was on the table and is making it considerably better by, normally in commercial mortgage loans, you've got a 10-year loan on an office building or a hotel or a mall. And you know what? At the end of the 10 years, you get your new appraisal and you're upside down a little. It's like, tough shit. Put more money in or we're going to foreclose on this thing and sell it out from under you. And that's the way it's kind of supposed to work. And there's been some other times when there was flexibility granted. Here, it's like major flexibility everywhere. Tucson Mall, B-Bubs, 2012 TFT, A, B, C, D, we traded everything in there. People thought we were crazy buying the C's in the 50s. Those are in the 90s now. Tucson Mall, that mall just got appraised by Brookfield, 165 LTV at a 10 cap, because it got appraised at a 6 cap before. 1.9 debt service coverage ratio. All these guys are saying for sure Brookfield's giving that one back. I was like, challenge. I'm like, they're not giving that back. It's got 1.9 debt service. They're going to negotiate some kind of a new deal. Like, they are not giving it back. Leading mall in Tucson, they're not giving it back. Like, a lot of guys are betting that they would. But anyhow, so I think that in situations like that where there's cash flow, that in this case, these loans matured. Brookfield negotiated a 3-year extension. They floated. It was their idea. Brookfield said, let's go on to 30-year ammo and pay down the mortgage every month. They also voluntarily said, look, we know it's only a 6 debt yield. That's like not great. It's not that bad either. It's a 6 debt yield. That's a dream for office buildings. The thing's already stabilized. NOI is going back up anyway. And then they said, look, next year to get another extension, how about a 7 debt yield? So we'll either pay the mortgage down or we'll earn our way out of it. And then to get a third extension, they'll do an 8 debt yield. And as my analyst, Isaac, had coined for some of our little creative research blurbs we did, he said it's the roadmap to the future. Anyway, so that might be the roadmap to the future in dealing with all these things that are maturing. And so anyway, the reason why, just to back up and I'll let somebody else go, but the reason why all of the conduit is very distressed, it's because people are very concerned with the looming maturity wall, which I believe will have the most incredible flexibility of all time. And then the 18% that are the delinquent pool, I believe, and I could talk about this later on, but I believe that 18% part of it has like 10 other types of flexibility and all these other things that are going to happen to a lot of the delinquencies, and that the cap rates right now on the delinquent part of the pool, I like to say, it doesn't matter what the cap rate is now. It matters what the cap rate's going to be in 3 or 4 years when any of this stuff is going to get sold. Because I don't think that any of the things that already went Rio, I've interrogated every special servicer there is right now, trying to figure out what the hell is going to happen to this stuff, because I don't want to lose money. And that I don't think that many of and you guys could chime in on this, I don't think that some of the things that have already gone Rio that are being operated by Spinoso or JLL or a bunch of these CBRE, I don't think that these assets will be sold for many years. And so anyhow.
I'll just put a point on that. If you take a look at what's been liquidated in the conduit universe, almost every month, half of all loans that are liquidated were issued pre-GFC or originated pre-GFC. So you're talking about loans that have been outstanding now for at least 15 years. And with very, very few exceptions, our market didn't do or doesn't do 15-year loans. So I'd like to turn over now to Pasquale Cardone. Why don't you give a quick introduction, what you do, how you're going to talk about the market today, and we'll go from there.
Sure. So I'm Pasquale Cardone, the founder and chief investment officer of PC2 Capital, based here in Miami. We're in Brickell, which, if you didn't know how bad Miami traffic was, it took me an hour to go 4 miles. So it's pretty bad, only getting worse. But PC2 focuses on commercial real estate securities. So we're active in CMBS, REIT equity, debt, and we can also look at real estate loans. I started PC2 last year to really take advantage of the dislocation from COVID-19 pandemic. And before I started PC2, I was a CMBS trader at Citi, where I traded different parts of the market, single asset, single borrower, conduit credit, CMBX. I've traded with both the other guys up here on the stage, so we all know each other. And hopefully I'll give some perspectives from what I've seen my time on the sell side, but also since I've started this fund and now looking through the buy side lens.
So then let me ask you, you started the fund, take advantage of dislocations,
Yep.
Came back from COVID. Where are you focusing? What's dislocated in your opinion? And is it dislocated and going to remain that way, or are you looking at it because it's currently dislocated and you think there's upside to it?
So I think now it's more kind of pockets of dislocation, where a year ago it was just broad-based dislocation, and it was more almost like a beta trade where the whole sector in CMBS was just, so beaten up that you had, hotel floater subs that went from par to 30 cents in 6 weeks. Right now, those have since recovered into the 90s. So that was broad-based dislocation. Now it's more, specific pockets where we can look at some areas of the retail market, like John's talking about malls. There's still pretty big dispersion on opinions on how those might work out. So you can find distress there. There's other areas of the market where legacy credit, Alan just talked about some of these loans that are liquidating now, 50% are pre-GFC. So that's an area I've looked at and kind of traded in, where you might have a pool with 5 loans and every loan's real estate owned. And you're making a bet on the not only ultimate recovery, but the timing of recovery. And if you get a quicker timing of recovery and a better ultimate principal recovery, then that's a very nice yield as this stuff comes through. So I think those are more the areas in CMBS. I could talk a little bit more about REITs, but there's also a lot of areas in REIT equities that make a lot of sense, just because the debt side usually recovers faster and then equity takes a little bit longer. But it's the same themes there: retail, hotel, areas that haven't fully recovered. And now with the kind of Omicron scare, I don't know if anybody looked at the markets today, but you have some hotels and some actual New York City office operators are retesting the lows, and in my opinion are kind of overreacting and almost pricing in a new pandemic, if you want to think about how fast that price action has moved. So I think that's interesting today too.
Okay, great. I have to ask you before we go on, when you talk about distress, let's just quantify it a little bit. What are you batting for? Is it double digit? Is it?
Yeah. So our stated return targets mid-teens plus. Look, the market's recovered so fast that I think it surprised everybody. Since we launched, I was, a year ago I would have told you I would have been happy making 20%, and I think we're up 40 net in a year. It just says how fast things have recovered. I mean, it's just crazy. So that's why I say it's not broad-based, it's more pockets now, and you have to believe that story or have a different view than the market on either that individual asset, maybe the market that asset is in, or the broader sub-property types, such as B or C malls. And that's what you're really doing is trying to use a different lens than maybe everybody else to look at some of these more specific opportunities versus broad-based. But I still think you can find in CMBS high singles on some things, maybe low doubles if you really have a different view and you're willing to take some all risk.
How much can you scale that?
How would you scale?
How scalable is that?
Maybe you could do, John can probably back me up here, 50 to 100 million in some stuff that's high singles in 2 months, 3 months, something like that. If you have $1 billion to put to work, that's going to be hard, right? That's going to be hard. It's more pockets. And I think the easier place to find those returns would be probably REIT equities now. But that's also a bigger market. It's a $1 trillion market cap market versus CMBS, $500 billion. The actual distressed part of it's $50 billion, maybe even less than that. Yeah. So just the float is smaller.
So what was interesting to me in listening to both of you guys is whether you're talking about the condo market or the SASB market, you know, it feels like we've gotten past this broad-based, prices have just gotten whacked, right? Baby's out with the bathwater. And now, whether you're talking about the SASB market or you're talking about a legacy deal or even a 2012 deal, you're really picking pockets where you have an opinion on certain either subsectors or an asset itself, right? So with that in view, I mean, Avner, when you're looking at a distressed opportunity, just for this session, how do you think about it? How do you go in trying to figure out, you know, what's going to happen? How do you think about the game theory between, if it's in CMBS, between a borrower and a special servicer? Can you share us a little bit, you know, share with us a little bit about what assumptions you make, how that assumption can drift based on what's happening?
Yeah, sure. And, you know, I mean, just from like so our total credit fund is around 25 billion. So for us, it's harder to kind of pick individual spots in kind of credit, like double B, CMBS, et cetera. So oftentimes when we're deploying kind of capital in kind of truly kind of episodic distress, you know, there's a ton of unknowns. And so the first thing you kind of try to ask yourself is, you know, what do the scenarios look like? What are the possible kind of outcomes that are in the realm of reasonable? So, you know, it's been a long time since there's been kind of a pandemic and there probably wasn't data back to the, you know, Spanish flu, but you ask yourself, what does the environment look like with 30% unemployment, 20% unemployment? And what are the kind of range of outcomes for kind of the investment that you're making? And so as long as your, you know, downside is, you know, acceptable and you have kind of a symmetry to the upside, I think that's kind of the essence of what we did. So when we were looking across all structured products, we're asking ourselves, you know, what is the environment that what does 20%, 30% unemployment look like? You know, 30% delinquencies, layer on global financial crisis or worse yet, and how bad are the return profiles going to look like? And so that's kind of really how we got confidence in terms of how we tried to kind of invest in those. You know, it's easier for us when we're focused on kind of the top of the capital structure, especially in those kind of pockets of opportunity, because they tend to, you know, not give you such binary outcomes. And you know, that's really kind of what we try to do, is just manufacture scenarios and really look at kind of return profiles in that environment.
I'll ask either of you guys, do you have a favorite asset class that you're looking at now? I mean, is it still retail? You know, you'd mentioned hotel. What I hear from a lot of investors is office is kind of the next thing that's coming. And how do you, if that's the case, and you can agree or disagree, you know, how do you isolate how to play that? So, Pasquale?
I can quickly. So, you know, there's still some opportunities in retail, but some areas have come back very quickly, where grocery anchored, you know, if we look back 6 months or 12 months ago, was very cheap. Now that's, you know, some stuff trading 4-handle cap rates. So that's not really there anymore. Now I think it's more interesting in hotels or office. That's the other place where I'm starting to look now, and especially when you think of, like I said, REIT equities in office, there's actually really good value. You look at some operators could be down 35.
From the long or the short side?
Long side, I actually think, because some of the equities are down 35 to 40% from, you know, pre-COVID times. And then you hear some people saying, well, we think, you know, office property values could drop 30 to 40%. It's like, well, the equity's already, you know, kind of priced that in a little bit. So if you think there's any reasonable chance that rents don't drop by as much as people fear, and, you know, more people come back into cities, which from the residential side has already happened. And rents in New York they're basically back to pre-COVID now, right? And supply is coming down, so people are living there again. It's only a matter
When you
of
say
time.
rent, you're talking, let's be clear, multifamily?
Multifamily rents, yeah, not office rents. But I think that's going to follow, because people are there. They're just waiting till they feel comfortable to go back in the office. And I think
Or until they're mandated.
Yeah, exactly. And some of the banks are forcing people back, where I think of my old place, Citi, originally said it'd be 3 days a week and 2 days from home. Now it's really, you know, they tell people in the news that's still what it is, but to traders, it's you're in the office 4 days a week. And then maybe the 5th day you can take off if it's not too busy, but you're expected to be there 4 days full time now. So they're really leading the way back. So I think that's on the way back. And then hotels really interesting because think of Miami as a market. Miami average daily rates are, I believe, 30% above 2019 levels, which I'm sure everybody realized when you look to book at this conference, and you're probably surprised. But resort and kind of destination areas have done very well, and that's because there's so much government stimulus and the transfer payments from the government to individuals that they had cash, right? And they had savings that were at 40-year highs not long ago that they used to travel once they could. And I think that story isn't going to change. Business travel, that'll come back at some point, but you have the leisure demand is there. But we look at certain hotels, and from the PE side, they're trading at 4 or 5 cap rates to 2019 levels. We look at these same hotel equities of the owner of that asset, and it could be down 30% from pre-COVID. So same thing, the assets they own traded at 4 or 5, but the implied cap rate on that equity is more than double that.
But if you're looking at, let's say, a REIT equity and they own XYZ hotel, right? They own other hotels.
Yes.
So effectively what's going to happen is you may love that hotel, but its performance is going to be diluted by whatever else is in the portfolio.
Yeah, that's true. And some of these REITs might only own 15 or 20 assets if you look at small and mid cap. And you can get pretty specific on geography, where they own them, what types of travelers, if it's transient, right? Leisure, group, et cetera. So you can get pretty specific, and yes, you're going to have other hotels in that portfolio that maybe they're not the best, but if they have a clean balance sheet, no near-term maturities for debt, all these other things, then I think you're in a pretty good spot to catch the upswing, especially if the assets are trading, like I said, pre-COVID levels, but the equities haven't really caught on to that.
Eventually that NAV discount will materialize
Exactly.
somehow or the other.
And that's what we look for. So you could find big discounts to NAV. You can look at replacement costs, discount to replacement costs. Sometimes we see 50% now. And yeah, you need a catalyst to close it, but as the cycle progresses and people feel more comfortable, the Omicron scare at some point is going to go away, especially if it turns out to be as not as severe as people thought. That could be positive, right? So there are catalysts to bring stuff back.
PC's talking about, I'll answer this question too, because the question stated again was, where do you see some opportunities? The PC is talking about stocks, which in a way are fairly efficient. So if you ask me, well, where do you see opportunities today? And I say, and I have a major luxury because I'm a broker dealer, and we've traded now, we went from like 0 CMBS counterparties to 70 in about 20 months, which isn't bad because all these CMBS guys are different than the RMBS and ABS. I haven't traded CMBS in 12 years, not one bond. And now I blasted into it, and I'm making markets between lots of guys, and they count on us to give liquidity. And I could tell you right now that if you've got a banged up delinquent triple B, double B, or single B, and you go to 10 dealers and try to get a bid, that you might not get any bid. You could go to anybody. To B of A is a player, and they'll commit some of their capital. Citibank is, that's it. Like maybe a little Goldman and a couple other guys that are out there and other guys, but like these distressed pieces, it is extremely hard to trade them. Believe me, because I'm used to banging pots and pans. That's what I do. I bang around. I model stuff. I understand how it works. I market it. I take very liquid stuff in, and it is as tough as ever. It's very, very difficult right now for any customers to trade some of these slices in conduit right now. It's extremely, extremely illiquid. Now, into all of that, if you know what you're doing, there's unbelievable opportunity because it's so damn illiquid that you've just got to look at like 10 or 15 things, and then a bunch of the things, if you're patient and you keep looking and looking and looking, you're gonna find things that are just crazy diamond in the roughs. It's like they're presenting themselves to me. And so it's tough to say, hey, like one area, like, oh, I studied all these different loans and there's a dream area I want to get exposure to. And it's like, yeah, good luck getting that exact thing that you want. You have to like wait till it comes to you. That's what I would recommend. It's like, and then it's, you're waiting for like, oh, did a fund close? Did somebody lose a separate account? Somebody tax loss selling. Like we recently bought some big blocks of like 10 to 20 million. We like to say they're thin and clean. They're like 3, thin means like 3 enhancement below you. The F's and some of the E's, like 3 or 4 enhancement up to like 7, 8 enhancement, clean, 1 delinquency. You know, we bought some blocks of some stuff in like the 50s, 1 delinquency, thin and clean. We're like, well.
Then why is it trading at such a distress?
Because there's no liquidity. That's what I was. I already went over that. I mean, this is like, it's so awful. It's thin and clean. These bonds like this would have been at 80, and these guys won't touch it. We bought a big block of 17 million of this bond. It's exposed to Avenues Mall in Jacksonville. So it's not a bad mall. They've never missed a payment. Simon, there's some competing malls in the area. Do I like Jacksonville? I love Jacksonville. I love Florida. Anything that's in Florida, all the population's coming here. So we're like, look, they've never missed a payment. If it comes down to Avenues, that they're just gonna get extensions. Simon can ask for whatever they want. This is gonna go on for years. So it's like, there's certain things where people want to sell stuff like that are clean. So we buy, some things are thin and clean. I mean, believe me, they're risky. I mean, you buy something with 3%, you don't want to put everything in that. I mean, you get run over and we'll lose everything. I mean, if like one of these malls blows up, I mean, or 2, then it's over. But if you layer a portfolio, this thing, we're modeling this thing, we think that this one Avenues Mall will get extended potentially several times. So we're modeling all those extensions into it. But I mean, we're seeing like, you know, 16, 17, 18% yields on extended bonds. It says it's a 40 yield to maturity, but it could happen that you get a 30 or 40 yield. So anyway, there's opportunities in conduit. It just sort of depends what it is. And you know, there's banged up Ds that are 8 to 17% slice of the deal that are pretty thick, that have 25 delinquencies, very messy. So that's the thick and messy is what I call those. I love those. I love all bonds. It comes down to what the price is. So some of the thick and messies, we buy those and the coupons are picking in the teens and $20 price for X triple Bs. I've got a whole collection of these things. Now, if it turns out that the loss severity and all these extensions on the malls all come out like where I think is actually gonna happen, and that the loss severity isn't gonna be 70 that everybody thinks, and the loss severity, because you're gonna wait, economy, the huge consumer spending tailwind boom going on right now. Some of the best consumer spending ever. Okay, consumer spending, by the way, that is the biggest fundamental force behind enclosed shopping in the mall. Sales per square, Simon reported they've got 117% of sales per foot over pre-COVID. This quarter, 117%. More shopping in malls right now. It's hitting records right now because why? Stock market's at an all-time high, residential real estate all-time high, not fueled by aggressive lending from the financial crisis. There's like a real problem with affordable housing in the country and inventory. And so this wealth effect, I predict that the space to be in underwriting would be in HELOCs and home equity loans. I bet you there's going to be tens and tens of billions of money that's going to come racing out through the conferences in the next 2 years. It's going to increase the money supply. It's going to worsen inflation, continue the consumer spending tailwind that we're all under right now. And that's why there's all this inflation. And so like right now people are nervous. There's all this fear. Oh, what about all the enclosed malls? But you've got to be smart enough to look out 1, 2, 3 steps ahead and then figure, hey, you know, like what else is going on? Like what about unemployment? Is it going up or down? How is consumer spending doing? Well,
I would say, just at the risk of this sounding like United Capital marketing commercial, I actually agree with John. Like, so one of the questions Todd's gonna ask is, you know, what's the cheapest kind of investment out there? And I think what the cheapest cash flows out there are actually retail cash flows, not necessarily malls, but just retail in general, where you have resilient, well-located retail, and you can buy those at 8+ cap rates versus sub 3 caps on industrial multifamily. I think those cash flows are resilient. I think that you can earn a great yield, and I think that yield will actually benefit in one of the largest risks that's out there for commercial real estate and all of fixed income and investing is just higher rates, right? You'll have that resiliency. The problem with it is it's not an institutional trade. It's not something that you can go to an investment committee on and say, hey, I'm buying this at an 8 cap, and I'm going to get this great cash on cash yield. But what's your exit? Like, you can't get an exit in 5 years because we know all the core funds are selling. We know kind of the REITs are, outside of Simon, don't have the balance sheet to do it. So and institutions just don't have the wherewithal to want to buy something where you can't underwrite kind of that profile. So I think, if you had private capital that had a longer horizon where you're not trying to get kind of promotes, et cetera, I think that is some of the, cheapest cash flows out there. So I tend to agree with you in terms of kind of looking at those cash flows. And I think, the way that you're going about it in the securities market is actually really smart, because you're not waiting for someone to take you out and buy that asset. What you're waiting for is just perception change, and then you can get 20 points, 30 points, and that works. But again, like for us to buy that same bond that you're describing would be kind of an exhaustive look at that Jacksonville mall and what are the different outcomes and what is it actually worth today. And you can't say that it's not worth 12 cap today because you can't find comps that don't justify it. There's no buyers unless you sell to NAMDA or whatever. And that would make it hard for us to kind of get approval. But it doesn't mean that that mall doesn't have resilient cash flows. No, and doesn't mean that it's not a good investment if you can find the right kind of hold it for the right kind of exit. I think it does.
Yeah, but it doesn't matter what the cap rate is today. It matters what the cap rate's going to be in 4 years, and after they extend it multiple.
By the way, it just matters what people think that cap rate's going to be.
So you could buy things that are theoretically upside down on an NAV, trying to market, and it still doesn't matter. That's what I'm saying. It's just because there's all the cash flow is in place.
The reason institutions can't do it is because you do that NAV, and you're like, oh, I'm underwater. It's harder for you to look at it when you're looking at it from a long-term hold period or a 5-year kind of return period in a private.
But I think this brings up a good point. Like we're saying, there's kind of pockets of opportunity. It's maybe a specific loan. Well, that brings idiosyncratic risk. So you really have to think about the portfolio level risk and how do you build a portfolio that has convexity versus an individual loan. So maybe you want a portfolio of 10 of these.
Oh,
right?
More,
because like you're saying, there's just so many outcomes.
You have to, if you can win on 3 and lose on there, then you've got yourself the right situation.
And that's really what I think John's saying here is, you might take some dings, but if you have convexity in the portfolio, overall it's going to work out and it's going to make sense. And we look forward 2 years, 3 years, whatever it is for the ultimate workout of these assets.
What is the average hold time that you plan on when you're buying something? John, let's go from what I would think would be shortest to longest.
Yeah, but I'm a very, very different player. I think that we're being told that we're like the number 4 counterparty to one of the biggest hedge funds out there right now in everything they do. And then we're like a top guy in the really banged up single B and double B, like including like triple B, but like we have a lot of flows. I just like what you guys are saying, like, oh, how much could you put to work in this stuff? Like, I think we're like a top 3 or 2 dealer in all the real banged up stuff and conduit 12 to 15. That's it. Because I see all the flows that are happening, and there's some things that happen like without on all the bid list and everything. So it's like this market that I'm talking about, it isn't that big. Like if we traded $2.5 billion of it, all this stuff doesn't spend that much money. There aren't that many of the for sellers. Our stuff, we're turning my whole book over like 1 time every month. We're trading, right now we're at about a couple hundred billion or a couple $100 million a month. I know I did this Veterans Day challenge where we offered to give away money to the veterans. It was very inspiring, and because I was working on some deals and I felt guilty that I was going to try to cut deals on a national holiday, and everybody was in because now Veterans Day, the stock market's open. So I said, hey, if everybody could do 10 trades with me, I'll give like 50 grand to this veterans thing. And it was really smart. We did like 16 trades. We did like 57 million of volume on Veterans Day, and we wound up giving 100 grand to charity. But so our volumes that day were 57 million. These are all very illiquid type of things that we're in. That's way above our general volumes, and we're doing like buys and sells. That was Hotel Sasby, Conduit. We trade every one of the mall things. I think the next day we did 47 million of volumes in this very illiquid stuff. That was another very, very high volume day for us. If we're doing 10 million a day in this illiquid stuff, that's basically 2.5 billion a year. And so our hold periods they're pretty short, a day, a week, maybe a month. We get stuck in a lot of stuff that's so illiquid that even I can't sell it. And I'm a professional salesman. And
it's because you didn't call me.
So
we own like maybe 120 million of current face right now in my book. I'm not that big. I've allocated some money into this MBS area, and then all that, I think on my offering list today spends maybe 57 million of proceeds. And then so if we have 100 and something million current, right now we're trading 200 million. So we're turning the book over like once or twice a month, in the flows. But some of the stuff doesn't get off the sheet. We own maybe 35 different offerings right now in my little Excel sheet I send out. So I think that kind of answers our activity.
So we've got a little less than 3.5 minutes. I want to switch gears here to a certain extent. You started off by saying there's very little distress out there. Pockets, yes, but very little in general. We really haven't seen the same type of selling that occurred, or same collapses that occurred, whether it was RTC or post-GFC. What do you think, where is all the distress going to go? Like banks, insurance companies, all these portfolio lenders have to be sitting on things that aren't performing as well as they'd hoped. Avner, when do you think this comes out? How does that play out?
Yeah, I mean, I don't know I don't know that there's that much out there in the sense that, performance is actually pretty decent outside of, and I said no distress, to me, retail has its own kind of variations of variables of what could happen. So I don't necessarily consider it's an underperforming asset class, but I don't consider it distress because there's a reason behind it, and it's not like it's new. So when you, part of what I think is when you look at kind of where these loans attach and where everything kind of was, asset prices snap back so much that, you can't have distress in multifamily or industrial because of what those asset classes are. I think office, I think there could be, but the long lease terms and timing is really going to kind of allow it to soften the impact.
So we're not going to all work from home forever?
I hope not. I can't stand it. But I do think there will be some opportunities in urban office because I think urban office is a real asset class. It's a dynamic asset, and I do think that there's going to be opportunities to reinvent and recreate value there. And then I think in retail, I think we've spent a ton of time talking about it, but I think there's going to be kind of workouts and needs to kind of reinvent that asset class. But I don't think it's going to happen all at once. And I think it can kind of slowly be absorbed.
So I guess we've got a minute and a half left. Guys, on the end, where do you what's the next trade? What are you going to do when retail resolves itself? John, you've got nothing left in your book.
Again,
or is that a 5 to 8 year proposition?
No, it's important to be patient and let certain things present themselves to you and have a very open mind. My whole career, I've always am willing to look at every asset class, and the more complex, the better. And I like the things that people get emotional about, fear. There's the rational, that fear, human emotion always presents some of the absolute best opportunities. So it really just sort of depends because the setup is when there's a lot of fear and emotion, that drives human behavior. That drives flows, supply and demand. Then the flows, when there's more supply, it makes the prices go down. So you kind of need that setup to get in my career, I've had a lot of home run trades. I've tripped up in the financial crisis. I bought part of a public company. I lost a bunch of money on that, but I'm not good at stocks. I shouldn't do that. But the setup it's when you have that emotion and fear makes people sell stuff, and then you go in and give liquidity and take the other side. And so I can't guess what that next thing could be.
There's always a shock and there's a reset of expectations, and that's when you need to kind of figure out what is actually real and what isn't.
Yeah, I think I'll just quickly say, we've benefited from this recovery from massive fiscal and monetary stimulus. That monetary stimulus is ending, right? So they're going to pull back on what they're pumping into the economy. They're probably going to raise rates next year, and the question is, if they raise 4 times instead of the 2 the market expects, then what happens? And then does new distress pop up? And then do people have to start maybe trying to sell loans instead of just kicking the can down the road or refining at a lower rate? So I think that could be the next area that becomes interesting, especially, like we said, industrial. Some things trade 2 handle cap rates.
Yeah.
That works with a 0 front end treasury. I don't know if it works with a 1.5 or 2% front end treasury.
Yeah.
So.
All right. Well, we're 45 seconds over. I think we've said it all. I want to say thank you very much to the panelists, to Pasquale, John, Avner. Thank you, everyone in the audience. If you have any questions afterward, I'm sure we'll all be milling around, so feel free to stop by and say hello.